You're now listening to the Supply Chain Secrets Podcast, the ultimate insider's guide for all things ocean shipping. Brought to you by Kaishex, helping you deliver through volatility.
Hi, everyone. You're listening to the Supply Chain Secrets Podcast. I'm your co-host, Caroline Weaver, and with me is Lars Jensen. Lars, how's it going?
Absolutely great. I have just arrived in a sunny summer Hamburg. What's not to like?
Amazing. And I take it you traveled a little differently this time instead of going by plane.
This is the last trial test run of my van Sally. And so far, that worked out like a charm.
Perfect. Glad to hear it. All right. Well, let's get started talking about this week's NYFI read. So let me pull up the latest rates here and let's get going. Maybe let's start off with Asia, North Europe. What's going on with this trade?
Yeah, as I think is evident for those who are also watching the graphs you put up, rates are skyrocketing rapidly on the Asia North Europe trade. I mean, compared to just a week ago, we are up $500 per 40 foot. We are up $1,000 just over the past month. And judging from the participants over on the futures market, we haven't even reached the end of the run yet. We are still seeing an apex come here in July, and that apex is also going up, not just by 500, but actually it's up by $750 compared to just a week ago. So basically the market participants are expecting this rally to continue as the peak intensifies. And maybe to give just one data point out there in terms of also how bullish the carriers see it, this might be an extreme outlier, so take it for what it is. But there was an announcement of a peak season surcharge from CMA-CGM of no less than $4,000 per 40 foot that they aim to put into effect here from July 10th. Whether they're successful or not, of course, remains to be seen, as always with the carriers. PSS or GRI announcements is down to how much will the market bear. But if you look at the graph here and see where were the rates back in the past, if you look at the NYFI here, and it's a hypothetical, if CMA-CGM is successful, and therefore also the market as such, to get a $4,000 PSS, this would actually put rates up in the territory we saw in early summer 2024, when we were in the throes of the first reactions to the Red Sea crisis. So to say the market is bullish right now would be an understatement.
Yeah. I mean, $4,000 is extremely steep. Do you think that that would stick, or do you think maybe you'd kind of meet in the middle somewhere?
I mean, given the market conditions right now, and we're going to talk a little about Hormuz later on as well, color me a bit skeptical in terms of whether it will actually be a $4,000 increase compared to where we are.
All right. Well, that would be good news for the shippers, maybe less exciting news for the carriers. But all right, let's switch over to Asia-US West Coast and take a look there. Maybe let's limit this a little bit so we can see a bit more clearly what's going on.
Yeah, the Asia-US West Coast rates are also rising very, very rapidly. We now saw them go up above $4,000 per 40 foot. There's a little bit of a difference here on what we see on the Asia-US West Coast versus the Asia-Europe, as you can see on the graph here. Even though futures rates actually did increase for July, they, unlike North Europe, they are not above where we are now. Give and take, of course, you can always say there's a bit of uncertainty in these, but basically what the futures market appears to indicate is that we have more or less reached the apex of where we were going to be. Now, an interesting element of this one is, well, that's the future indication. We're actually trading on this. And the answer to that, especially as we've seen over the last week, is yes, they are, both on US West Coast and on North Europe. You had Freight Investor Services come out announcing the first trade they'd seen on the US West Coast. That was back on Thursday, a relatively small lot. That was at a level of some 3,600. But that was before the weekly futures rate index came out, which has actually increased even further. It has fallen back slightly here with oil prices coming down, but we're still almost up at 4,000. And coming back to what I mentioned before, is anybody actually trading on these ones? The latest data indications are there's now being traded more than 1,000 lots. So that's 1,000 40-foot equivalents per week using the NYFI index. This covers both Asia to North Europe, as well as Asia to US West Coast. So with the changes we're seeing in the market, that certainly also appears to be prompting more both shippers and carrier interests to hedge their bets, so to speak, in terms of what's coming.
Yeah, definitely. It might be interesting to also talk a little bit about volatility on this lane in particular. We've seen a bit of an increase. Could you talk a little bit about that?
Yeah, I mean, this is also part of the data portfolio on the NYFI indices. That is a measurement of the volatility. And volatility has also gone off the charts here compared to at least where we've been in 2026. This is likely also why you have suddenly seen an increased flurry of activity over in the futures market. Because with volatility suddenly going sky high compared to where we came from, that of course incentivizes a lot of participants to precisely hedge their bets and say, we can't live with this volatility. We need some level of security there. But of course, when we look at the increase in volatility here over the past week, which indeed has flown off the charts compared to where we've been this year, it's also interesting to look at how does this look compared to the very volatile years we've just come out of, so say 2024, 2025. Mm-hmm. And if we cast them in that light, yes, volatility has increased sharply, but we're still not at the levels we see three massive spikes in 24 and 25. The first extreme spike was really driven by the immediate aftermath of the Red Sea crisis outbreak. Then we saw another major spike. Again, this is the Pacific. That is with all the trouble and hoo-ha around the US-China trade war, the 100+% tariffs that came and went. And we saw a similar tariff-induced spike as we were approaching Christmas last year. So the increase in volatility now is not as extreme yet as what we saw from Red Sea and the US trade war. But that is certainly no guarantee we won't get into the same type of territory. Again, two out of these three spikes that we've seen were driven by the trade war. And what we have indeed seen over the past week to 2 weeks are findings by the US Trade Representative basically laying the groundwork for new tariffs to be announced and implemented over the next couple of months from the US as the Section 232 tariffs are disappearing and are to be replaced with something else. Maybe to round this one off and say, well, if volatility isn't as high now as it was back then, why was it not a prompt back then for people to start digging more into the futures market? Well, in this case, it's extremely simple. All the NYFI futures have only been launched here in recent months, so it was not an option there back then. Yeah. Now, fortunately for those that don't like volatility, it is an option.
Yeah, very good point there. All right. Well, thanks for sharing all that. I did want to note for our listeners that we got some feedback that we're sharing the charts and it's sometimes difficult, especially if you're not on YouTube watching the video, to follow. So what we decided to do is create a newsletter. So if you want to subscribe to the email distribution, we have a link in the show description, and we'll send out a weekly recap of what we talk about at a high level in the episode, as well as we'll include the visuals of the charts. So that way you don't have to miss out anymore. So feel free to subscribe to that if you want to see the charts. All right, let's move on. So we do have some updates on the Strait of Hormuz. Big news, or is it? Maybe let's talk through that. What are the latest updates there?
Yeah, the latest update, well, it is big news, but what is going to happen depends very much on how you choose to interpret what is happening. What appears to be happening is that the US and Iran have agreed on some sort of memorandum of understanding. They are supposed to be signing this in Switzerland here on Friday. But then this is where the interpretation starts, because neither US nor Iran have released the actual wording of the document. So we don't know factually what it is they have and have not agreed. It appears that this memorandum of understanding means there's another 60-day period to actually make a deal. So this is not a final deal. That's the first thing. Secondly, you have seen announcements from Iran that the strait is open. They're pointing out 5 of their ships have gone in and out. You have had announcements from the US saying that the strait will be open without tolls. You have had the officials from the Iranian foreign ministry saying the strait will be open, but there will be safety and security fees. You have the Iranians saying this is only a deal if Israel also stops their aggression. You have Israel saying that they're absolutely not a part of this deal. So overall, this leaves us
With a lot of variables.
Yeah, exactly. Because depending on where your allegiances lie, you can choose to lay weight to some of these statements and not others and come to completely different conclusions. I was checking Vessel Finder for the AIS movements. Again, vessels can turn off AIS, so we can't see those. But based on the vessels we can see over the last 24, 48 hours, there's basically not been any change in the pattern. A few ships going through, which is no different from the pattern that we had prior to this memorandum of understanding. It appears to me that the shipping lines are kind of leaning back and saying, yes, it would indeed be great if we can begin a normalization, but let's just give it a few days and see how this actually pans out, what becomes open, what doesn't become open. One of the gray zones here, of course, is also, what about the alleged mines in the Strait of Hormuz? We don't know if there are mines. We don't know how many. Various experts out there have thrown their lot in and saying this is going to take 2 to 3 weeks. Some are saying as much as 50 days to get mines cleared. So again, when this can return to normality is very much unknown. So with all those unknowns in place, let's remain optimistic. Let's say this is actually the beginning to the end of the Hormuz crisis. We should probably expect 2 to 3 months for container shipping to resume to normality at least. It's not just a matter of vessels needing to shift in schedules. You will have a lot of loaded cargo waiting in ports elsewhere around the world that basically has been stuck ever since this started.
Right.
And the shippers were not willing to pay the exorbitant fees to take it overland. All this cargo now needs to move. That is likely to create some capacity and bottleneck issues. You also have an enormous amount of empty containers that needs to get back into flow. So from the most optimistic perspective, 2 to 3 months at least to get back to normal operation. But what I think is much more important is actually not Hormuz itself. Because if we remain optimistic, Hormuz gets solved, that highly likely also means the Red Sea crisis gets solved. This is where we were January, February on the cusp of returning to normal in Suez. So if that is the case, we could also expect an imminent change there. This is where it gets truly interesting because I remember we were discussing this on the podcast back in the beginning of the year, that the best timing for a normalization was right after Chinese New Year, because that is when there would be low volumes, you'd have minimum operational disruptions.
Mm-hmm.
Beginning to change now would basically ensure maximum operational disruptions as the cargo arrives in Europe. But if you're sitting from a carrier perspective, it's actually not the head haul you would want to shift quickly. If anything, you would want to shift the back haul quickly. Again, hypothetically, if you were to shift the back haul now, those large vessels would then be ready to load cargo in Asia 3 or 4 weeks from now. And we started this podcast looking at not just how high the spot rates on Asia-Europe were, but also that there were future indications showing this was going to be even higher. And we had the CMA-CGM peak season surcharge of as much as 4,000. If anything, that is a massive incentive for the carriers to shift some of their Asia-North Europe services on the back haul back to Suez to get the vessels out in Asia positioned to capitalize on these extremely high freight rates by pushing in more capacity. Obviously, with the result that then the spot rates are not going to be as high because there would be more capacity in place. So that would be kind of a different scenario than the one that unfolded or was about to unfold early in the year with minimum disruption. Because as I mentioned, if this is actually going to play out, you're talking a lot more volume than coming into North Europe and creating this ketchup effect, creating more congestion problems in Europe once we get to early autumn.
I think it might be worth just very quickly explaining why the Red Sea might open up, given that it's been closed for years. So why would this suddenly change?
Let's keep in mind the Red Sea is closed because of the Houthis that are basically occupying northern Yemen. The Houthis are a proxy or allied with Iran, very much the same way as Hezbollah in Lebanon is allied with Iran. And it was basically Iran supporting the Houthis' embargo in the Red Sea. The Houthis were very much adamant that in September last year, there was now a ceasefire. They wouldn't shoot at anybody, which is why you saw Maersk and Hapag-Lloyd begin to come back in January, February. But because the Houthis are allied with Iran, the breakout of the Hormuz crisis meant that the shipping lines were afraid the Houthis would side with Iran and start shooting at ships again. The Houthis haven't. They have shot a few missiles at Israel without hitting anything, but they have actually not shot at any ships at all. So that's why if we get a resolution to the Hormuz crisis, the Houthis are likely also going to be told by Iran, let's bury the hatchet, let's not shoot at anybody. So that would set up the stage for resolving the Red Sea crisis, which from a global perspective is much more important than the Hormuz crisis.
Yeah. There's a lot going on here. I think it'll be pretty interesting to see what happens over the course of the next month or two. It's really just dependent on what actually happens with this ceasefire and if it materializes, right?
Yes, I like to have the optimistic hat on here, and I hope truly that this works. But we should also keep in mind that everybody was similarly optimistic more than 2 months ago when the ceasefire between Iran and US was announced. At the time, it was also announced that there would be free passage through the Strait of Hormuz. That lasted less than a day at the time.
Yeah, so definitely conditions are subject to change here. All right, well, we'll keep an eye out, and of course, we'll report on this next week as things progress. It might be interesting to talk about some piracy activities that have been going on too. So what's been going on there?
Yes, that pirate activity has picked up again in the Gulf of Aden, nowhere near the epidemic proportions we had 15 years ago with Somali pirates. But over the last 2 days, we actually had 3 piracy incidents around the Horn of Africa. 2 of them were in the Gulf of Aden. And since we're sitting here talking about container shipping, it's worthwhile noting that one of the ones that were attacked yesterday was actually a container vessel, a 1,700 TEU feeder vessel Maersk is operating between Salah and Djibouti. The 2 attacks yesterday basically happened with small skiffs with armed people shooting at the ships. Ships either sped up or had armed guards that could then repel the attacks, and the pirates were unsuccessful.
Is that pretty common for this part of the world to have armed guards on the boats?
To some degree, yes. Again, the piracy challenge has increased over the last 6 months or so. It's hard to say that it is directly related to the Strait of Hormuz, but it does appear that the challenges in the Strait of Hormuz has emboldened some of these pirate attacks. I'm not a pirate. I'm not privy to their discussions. But I could certainly envision a scenario where the pirates will say, well, all the Western military forces in the region have their eyes fixed on the Hormuz Strait. So why not be opportunistic and try to go for some more activity?
Yeah, capitalize on the moment right now.
Yes.
All right. Well, we'll continue to monitor that. Something else that we've talked about in recent episodes was El Niño. So do we have any updates there on how that's impacting shipping?
Yes, we do. And the update is one where shippers that use the Panama Canal should no longer think of this as a scenario. They should think of this as a baseline they have planned for. The reason for that is NOAA, which is the agency in the US that comes out with the most detailed monthly updates on monitoring the El Nino. The one they came with on Thursday announced officially that now there is an El Nino. That was not really surprising. We already had a 98% likelihood of that happening. That is what it is. So officially, there is an El Nino. What is much more relevant here is the forecast of how strong is that going to be. I think I mentioned on one of our previous podcasts, you got this grading scale, very strong, medium, weak, very weak. And in the categories called strong or very strong. When I look back in weather records, every single time that happened, you also had a massive drop in the water levels in Lake Gatun in Panama.
Oof.
That is what drives the Panama Canal, and low water levels reduces the capacity of the Panama Canal. Now, the update, when we talked about this a few weeks ago on the podcast, it was a 67% chance of a strong or very strong. Now, this is an 88% likelihood that from November to January, we are going to get a strong or very strong. And NOAA, in their latest forecast, not only have an 88% likelihood, they say it's likely this is going to be the largest El Nino event in the historical record, which goes back to 1950. This is a significant issue. It's also clear, even before this update came, that the Panama Canal authorities are preparing for an impact. We've already a couple of weeks ago talked that they were already now reducing some of the draft restrictions that they had for major vessels to start to conserve water. But they have also done other things. If you have two small vessels, they should now use the same dock at the same time. They have some hydropower being generated also using the same water. That has now also been terminated. But an 88% chance of a very strong El Niño, with a fear this is going to be the strongest in the last 75 years, or at least as long as we have records on El Niño. What this means for shippers is if you're shipping from Asia to US East Coast, you will be impacted. If you're shipping from West Coast South America, so let's say you're exporting fruits and veggies from Chile, Ecuador, Peru, and going to Europe or US East Coast, you will be impacted. If you're on South America East Coast, you go to US West Coast, you will be impacted. If we think back to 24, where ostensibly this could be worse than 24, there were substantial restrictions on draft. There was a restriction in the number of sailings. At that point, you did have some container vessels suddenly going between East and West Coast South America. So this is definitely something to watch for shippers. What can you plan as a shipper? Well, if you already now, let's just take an example, you're shipping Asia to US East Coast. Either you already sit down now, then you look back in your records in 2024, how did this impact your freight rate in order to get cargo actually moving? Because you will be impacted, again, by higher freight rates due to the restrictions. Alternatively, you can ship your cargo via Suez. This is where we should hope the Red Sea crisis has been resolved, because that at least will make it better to use the alternative to go through Suez. For those that are not intimately familiar with geography, if you're shipping from Asia to US East Coast, there's a center point basically in the middle of Vietnam. If you are north of that center point, it is shorter to go through Panama to the US East Coast. If you're south of that, it's shorter to go through Suez. If we now get a restriction in Suez, the cargo that's best able to ship would be the cargo that's basically in the northern range of Vietnam and the very southern range of China. And if you're looking at the really large port complexes there, then we're talking Yantian, Jensen, Hong Kong. So if you're shipping from that area in particular, and also from northern Vietnam to US East Coast, maybe already now begin to explore what are my options for the routing through Suez instead.
Yeah, this could have very wide repercussions. We're talking a lot about the throughput of it, but what could potentially happen with the rates? It sounds like it could affect multiple trades, given that they're all using the Panama Canal.
They're all using the Panama Canal. And again, if the Panama Canal gets restricted, shipping is what shipping is. If you don't have enough capacity, rates go up. And as we have seen in the last 6 years repeatedly, rates will go up in favor of whoever wants to pay the most. And that's typically the most valuable cargo if you look at value to volume ratio. Other cargo would either have to not be moved or have to use alternative routing. Alternative routing on shipping, it's the other way around the world. It's the Suez one. Then there are two other alternative routings as well. You can ship it in to the North American West Coast and then rail or truck it across, which of course also comes at a cost. Then you can rail it across the isthmus down in Panama. There is a rail line next to it, but that very quickly gets filled to capacity. And the latest option is also the Trans-Mexico cargo rail line that opened just some 6 months ago. But again, as rail lines go, it's limited capacity. You can do it, but not everybody can do it.
Yeah. If you've been curious about futures, this might not be a bad time to look more in depth into it, because if you have seen what your freight rates were back in 2024, you might want to make some decisions that could potentially help you sort of hedge against the volatility that could be approaching here.
Yes.
All right. Anything else you want to add for today's episode, Lars?
No, I think that is plenty, especially with the homework we gave everybody that's using Panama to look at what is your contingency plan, because you might actually need it.
Yeah. All right. Well, thanks everyone for tuning in. Again, we are going to be releasing that newsletter every week, so go ahead and subscribe in the show notes so you receive that to your email. If you haven't already subscribed to the podcast itself, we are on Apple Music, Spotify, and YouTube. And we are here every Monday, sometimes on Tuesdays. Thanks for bearing with us this week. And we'll talk to you next week. Bye, everyone.
Thanks for listening to the Supply Chain Secrets podcast, presented by NYFI. Be sure to subscribe on your favorite podcast app.